Welcome back to Module 3. In Part 1 you learned about stock classification, and in Part 2 I brought you to how to pick your first stocks. In this video we're going to outline how you can build your own portfolio. The first step is to open an account with a stockbroker or an advisor. You can of course choose your own stocks or equities without an advisor, but if you want to invest in bonds you must do this through a broker. Step 2 is defining your financial needs and your investment goals. Start by taking a close look at your current finances. Remember that you should only invest money that you can afford to lose. So build an emergency pot that you can set aside for when things don't go to plan. Then, and only then, you can start to look at what you'd like to do with your excess cash. Next is a big question. What are your financial goals? You might have a lot of goals, and coming up with the answer might seem overwhelming. So try break them up into short, medium and longer term goals. An example of a short-term goal might be to start investing this year. A medium-term goal may be to buy a house in 5 years, and a long-term goal could be to save for your retirement. It's hard to answer these questions objectively, so it's best to discuss it with a financial advisor, and remember that as an investment club member you can avail of a free financial consultation. Once you've gotten very clear on your goals, you can look at your financial situation and decide how much of your excess cash you want to invest. Looking at your long, medium and short-term goals will also help you assess when you need to access your funds and the length of time that you are willing to invest for. What might be coming up in your future and what you need to financially prepare for now. Before you go any further, you need to evaluate your attitude to risk. As you've heard a few times before, you may lose some or all of the money you invest, and you should never invest more than you can afford to lose. So ask yourself, what amount of excess funds can you afford to lose before it has a negative impact on your lifestyle and well-being? Remember that you're investing with the aim of securing your financial future and creating long-term prosperity, not putting all those things at risk. In step 3, you can now start to look at your investment options and decide what best fits your financial goals. There are many different avenues available to you. You can start investing on your own and trade in stocks online. This is a very low-cost, convenient method if you want to pick your own shares and exchange-traded funds. However, you will need to do all your own research, and this can be time-consuming. This way of getting started might not have a larger goal other than just learning how stocks work and dipping your toe into markets. You can decide your own level of commitment, and you can stop trading at any time. A lot of our clients simply want to grow their nest egg for a particular life goal or a pension pot that's tailored to your needs. This would be a commitment that would last longer than 5 years, and it would concentrate on low-risk investments. Here, a financial advisor would give you a full personalised review and advice on how to best save and invest capital. A goal-specific plan might be building wealth to purchase property or pay for your children's education. In this instance, a fund manager chooses investments for you while keeping your risk profile and diversification in mind. The investment can be 5 to 10 years and does not require much administrative work from the investor's point of view. If you need something more bespoke, a personalised investment strategy might be the way to go. This is a portfolio that is designed around your financial goals and can accommodate complex investment needs. It is usually composed of many different investment pots to meet different goals. All short, medium and longer term goals may be accommodated in one investment. Again, this fund is managed by an advisor, not an investor. Investors with a strong interest in markets who are open to higher risk investments might be suited to active trading. These investments leverage the trader's long-term knowledge and expertise. And because it's high risk, there are potentially higher returns for investors. To give a real-life example from our case studies, we had a client, Ashley, who was a medium risk investor whose main objective was to build capital for the long term. For her, we designed a diversified portfolio to spread her capital between stocks and bonds. Investing entirely in equities was too high risk, therefore some capital was invested in government bonds and investment-grade corporate bonds. We reviewed the portfolio regularly to rebalance all assets. Keeping in mind that your portfolio is just that, your portfolio. It needs to serve your needs and your investment goals, not anybody else's. So don't be swayed by what other investors are doing. As you've seen from the case studies in the Masterclass, all investors are different, and when it comes to building capital, the options are available to suit every investor. Life changes are inevitable, and your investment goals can also change, so don't be afraid to keep tailoring your investments to your circumstances. I'll be back for Module 4, where we'll learn more about market timing, private equity and share options. Good luck in the quiz, and don't hesitate to contact us if you've any questions on this module.